Hello, everyone, and welcome. Thank you for joining us today for our 2026 ERCOT Market Update. I'm Cindy Reynolds, Director Commercial Sales, and I'll be your moderator today. Before we dive into today's presentation, let me explain how you can engage with us during the webinar. If you encounter any technical issues, please type your concern into the Q&A box beneath the presentation window, and a member of our team will assist you. Joining us today is Bill Barnes, Senior Director of Regulatory Affairs, and Carl Cook, Client Strategist. The purpose of today's presentation is to provide information for informational purposes only. Consult with your own advisors before acting upon any information contained. All right, the webinar today, we will discuss regulatory policy. This is more of a snapshot of the policies and actions that impact pricing and market constructs, including updates on large load additions, load and batch interconnection rules, transmission cost allocation, and reliability standard assessment of the ERCOT region. We'll look at market drivers, an in-depth look at energy market fundamentals, including supply, demand, economic and geopolitical factors, along with a review of historical and forward pricing trends. Finally, we'll round out with purchasing strategies from expert tangible examples of energy purchasing strategies for businesses that align with current market conditions and various risk tolerances. So thank you to those of you who have actually submitted your questions prior to the webinar. But if you didn't have a chance to, feel free to enter your questions into the Q&A box. To enlarge the window, just click and drag in the top right corner. And now I will turn it over to Bill to get us started.
Thanks, Cindy. Appreciate the intro. I am Bill Barnes. I cover all things ERCOT regulatory for NRG here in Austin, Texas. And I'm sure, as you guys know, there is a lot going on these days, particularly regarding the large load space and all the growth that we're seeing. So we're going to particularly focus on large load related policies and large load topics to kick things off here. So the first is the latest look at the large load interconnection queue, which currently sits for the April update at 440,793 megawatts of large load requests. These are simply interconnection requests submitted by data centers, large load customers to their TSP. They are highly unlikely to all energize. Obviously, adding 400 and some thousand megawatts to the ERCOT system would be problematic. So these are more just requests seeking studies on the quality of sites, and the queue will eventually be disciplined and criteria met, which will help us understand what loads are more real and less real. But at this point, as you can tell, most of the requests are front of meter. Those are the gray portion of these bars are standalone. And then the teal section are co-located large loads that are planning to be developed along with generation. In terms of types of load in the queue, at this point, we are pretty much 95% data center. This has evolved over the last 3 years, where we at one point had a majority of oil and gas load growth in West Texas that drove the large load queue, then crypto. Now we've evolved to the point where it is mainly data centers. You still have some interest from crypto, about 3.3%, 1% industrial load growth, and then hydrogen has been steadily declining and is below 1% in terms of types of loads that are interconnecting. So obviously, when we look at the large load queue, the number one question I get is, Bill, what's real? What do you think is real out of 440,000 megawatts of interconnection requests? What I like to look at in terms of the phase that these large loads have progressed to is what projects have been either observed to take service have been approved to energize or have planning studies approved by the TSP and ERCOT. That currently sits at around 30,000 megawatts for by end of year 2030. So those are pretty firm. Those are likely to occur. A lot of the other projects that you see on here, orange, no study submitted, indicates interconnection requests that have not progressed to the point where those studies have been conducted and handed off to ERCOT. Purple is TSP studies complete, and ERCOT is under review, is reviewing those and conducting their analysis. And then the gray part there at the bottom is completed interconnection studies, and then approved to energize, and then the green is approved to energize. So we've got about 6,000 megawatts that have been observed to take service of large loads. Another kind of key thing I watch as well is the progress at which ERCOT has been approving planning studies and approving large loads to energize. And this has been stagnant for a while. The big change here is in the last few months, we've seen a pretty decent uptick in ERCOT approving planning studies from 24,000 over 32,000 in the course of 2 months. So that's a pretty big jump compared to the historical pace at which ERCOT has been conducting planning studies. My guess, what's happening there is in order to meet the batch 0 criteria to be included as baseload, you have to have completed interconnection studies. So I'm guessing what's happening is you're seeing a kind of a mad dash here at the end. The criteria is probably going to have to be met by end of July, which we'll talk about in a little bit when we get to batch 0. So I think you're seeing a rush here of folks to try to get their studies in and complete so they can make batch 0 and be treated as baseload. I will explain what that means in a few slides. Another interesting trend of large loads, which has changed over the course of the last 2 years, is the size of large loads seeking interconnection. This is a look at the queue, but broken down by distribution of project size. So left to right in gray, those are the smaller scale large loads that are less than 250 megawatts, but equal to greater than 75. Got 110 projects there, about 20 or 18,000 megawatts of load capacity. And as you move left to right, purple are your 250 to 500, and then 500 to 1,000. And the green are what I would consider your super large loads data centers, 1,000 megawatts plus. This trend, if you were to go back 2 years ago, would show you the opposite. By far the larger or the most interconnection requests would have been from the smaller sized data centers. Now we're seeing the large hyperscalers, big projects coming in over 180, 1,000 megawatt plus projects for nearly 300,000 megawatts. This poses somewhat of a concern, mainly because there are stability issues with large data centers. If you trip 1,000 megawatts offline, that can cause some issues on the grid. So that is why ERCOT has had to propose and move forward with ride-through requirements for large loads. We're also going to see some stability or some synchronous oscillation requirements as well. And then consequential load loss requirements where you can't trip. If your data center trips offline and it results in a consequential load loss of 1,000 megawatts or more, that violates a reliability criteria. So those large data centers just require some additional kind of scrutiny. So that's the queue. The next, really, the step of transitioning from an interconnection request into something more real is to meet the criteria to be added into ERCOT's load forecast. ERCOT published their official 2026 load forecast a few weeks ago, at least the update. And what you'll see is those numbers are still significant. Senate Bill 6 was passed last year in the 89th legislative session. Senate Bill 6 included criteria that large loads have to meet in order to be included in ERCOT's load forecast. The hope here is that we would start to discipline the queue and we would get a better sense of what's real versus what's not real. In my opinion, that did not happen. And I'll explain why in a couple slides. But the forecast here, so if you look at the bars on the left, that's ERCOT's typical historical load forecast methodology. And then when you add in the large loads and the medium loads, which are between 75 and 250, you get the blue bars, which show a peak demand of 112,000 by the end of 26, going up to 367,000 megawatts of peak demand by the end of 2032. Why that causes me some skepticism is because the all-time system peak demand record for ERCOT, which is the box in the middle of the screen, is 85,000 and change for summer. That was achieved August 10th, 2023. The all-time winter peak demand from last February was 80,500. So meeting a 100,000 megawatt peak demand would be a stretch and would be difficult for the system to meet. And obviously growing to over 300,000 megawatts poses significant reliability and policy challenges, which is what we're trying to get in front of. The load forecast is primarily made up of the large load interconnection data. So you submit an interconnection request. However, that interconnection request cannot appear in ERCOT's load forecast until it has met certain criteria, which includes disclosures of duplicative sites. We don't want to be double counting sites in the load forecast. Also, the project would have had to demonstrate site control through an executed lease or deed for the land. These projects all have met that criteria, surprisingly. And then they also have to meet financial commitment requirements, which includes one of the three. Either you pay $100,000 per megawatt of financial security based on your contracted peak demand, or you pay 100% of your long lead time equipment, So that's typically your transformers, big breakers that take 6 months or more to procure. Or you have paid 100% of your contribution in aid of construction, also known as kayak. That is your interconnection facility costs. If you met one of those three financial criteria and you have site control, you will be included in the load forecast. As you can tell, there was hundreds of thousands of megawatts that were able to meet that criteria in 2026. There will be a different set of criteria moving forward in 2027 and beyond. You'll have to have a signed interconnection agreement before your load can be included in the load forecast. Why is that significant? It's because ERCOT's official load forecast is what's used for transmission planning. That's what we use to decide how much transmission we need to build. And also it's used in the resource adequacy assessments like the CDR. Interesting data point here is ERCOT also included a high-low case for the amount of peak demand they see in this year based on the large load growth. The box on the right, which shows 90,466, is their low summer case. Again, 90,486, that's their low case compared to a all-time peak demand record of 85,500. By the end of this year, ERCOT's tracking another 7,600 megawatts of large loads that can interconnect and energize by the end of the year. That gets you to 98,000 of peak demand for this year. Emphasize on this year. All right, so shifting gears, what are we doing about all this? Significant load growth, right? That's great for the state, economic development, investments in the state of Texas, property tax, all those benefits, but also concerns with affordability, costs going up, prices going up, transmission infrastructure that may or may not be utilized. So how are we getting in front of all this? Two major policy initiatives underway currently. First is the batch study process, which is a complete redesign of how large load interconnection requests are studied and processed. The first initial batch study is called Batch Zero. It will have different rules and different criteria compared to every other batch process that happens after it. And the main reason is because we have a significant backlog of large loads that have progressed either through the process and have energized, or are through most of the process and are waiting to get energization and completed studies. And so we have to process those first and clear that queue, clear that backlog before we can move forward and thinking about what the poly should be on a long-term basis. So clearing the 2 to 3 year backlog is really the goal of batch zero. NRG is strongly supportive of flexible data center arrangements, either controllable loads or bring your own generation, BYOG. And pleased to report ERCOT did file both CLR and BYOG rules for batch zero. We'll talk about that in a little bit. And then the Senate Bill 6 implementation. Lot of pieces of Senate Bill 6 that are really important to help us manage this load growth. And we'll talk through each one of these pieces. And I got some breaking news for you guys on the transmission cost allocation and 4CP. All right, so batch zero, BYOG. So this is a part of the rules that were filed on Saturday by ERCOT for batch zero, and it includes preferential treatment for data centers that are co-locating with generation. Essentially, what this means is if you are developing a large load site and you're bringing new generation to the ERCOT system, you will be able to energize and take service on the timeline consistent with the commissioning of the generation resource, and you won't have to wait for new transmission to be built. My guess is we're probably going to see 40 to 60,000 megawatts of large loads in batch zero that are, quote, base load, which means that they will get 100% of their interconnection allowance. The rest of the loads that qualify for batch zero will be studied and allocated a lesser amount of their interconnection request, and will have to wait for transmission system upgrades, such as the 765 kV strategic transmission expansion plan that has been proposed in the ERCOT stakeholder process. Also, the Permian Basin Reliability Plan includes large loads in it as well. That has been approved by the commission. That is the first part of the 765 kV system upgrades, where you're going to get 3 major import lines into West Texas. So the thing I want to kind of highlight here is, if you look in that red box, if you're a large load and you're included in batch zero and the transmission system is oversubscribed, which will probably happen in batch zero, then you have options. Your options are wait for the next batch study, or elect to take a lower amount until new transmission is built, or have a BYOG arrangement where you will pair with generation. When that generation is commissioned, you can take full service. You get your entire data center is approved to energize. You will have a withdrawal limit imposed on you from the ERCOT system. So you can only import an amount that the transmission system can handle from the ERCOT grid, but you can serve that entire large load on site with your generation. That is what will be up for vote this week in the ERCOT committees. What's next? What happens after we get batch zero behind us and we approve these rules, which again, this month of May is going to be very busy in the ERCOT stakeholder process. We'll be voting on the batch zero rules at various committees this week and next week to get to the June board meeting for ERCOT to approve batch zero. And then we will transition to the longer term rules for batch one and beyond. That will take up the remainder of the year, with the goal of getting that rule set to the December ERCOT board. That's your batch process in batch zero. I'm going to transition now over to Senate Bill 6. So the parts of Senate Bill 6 that are currently in progress. One, we have completed 2 of the rulemakings for Senate Bill 6. The first being the load forecast criteria, which we've already talked about. Those rules in 27 and beyond should give us a better look. ERCOT and the commission have also noted that they're going to look at making adjustments to the load forecast and try to look through the data and get a better idea of what is more likely to occur in terms of the load growth. on the load forecast. So look for that at the open meeting this Thursday. And then net metering arrangements with existing generation, that rule has been completed as well. So if you're looking to add a new data center behind an existing generation resource that was standalone, ERCOT connected as of September 1st, 2025, you'll have to go through the process that this rule establishes, which includes getting your load interconnection studies done. ERCOT then conducts a separate 120-day review of transmission security and resource adequacy. And then the commission and ERCOT can impose conditions on those arrangements where ERCOT can direct and dispatch that generation resource to point back to the ERCOT system, and the load would have to either curtail or be served on site behind the meter with backup generation. And then the rules that are in flight currently is the large load interconnection standards. This we'll talk about on the next slide, but it really establishes the entry and exit criteria for the batch process and what financial commitment requirements and contractual provisions need to be met in the interconnection agreement and the intermediate agreement. We'll talk about what that means. The commission is also progressing. There was a solicitation of questions for stakeholder comment on developing a reliability service for large loads. Think of this as a new demand response product focused on large loads of data centers, where there will be some compensation for data centers to voluntarily take their site off the ERCOT system 24 hours in advance of an anticipated emergency event. And then 4CP, which we'll get to that in a second. Got some breaking news on that. Okay, so large load interconnection standards. As currently proposed by the commission, which is and will change, I just want to be clear, we are in the rule development phase of this, and there's been a lot of feedback provided to the commission from various parties, I think over 50 commenters. But as it sits right now, conceptually, there will be an intermediate agreement, which is a preliminary gate to enter in a batch study where you prove up that you're more real. To meet that criteria, you'll have to pay a study fee, $100,000 if you're below 250 megawatts, $300,000 if you're higher than that, as currently proposed. There will be an option, more than likely, to provide security for long lead time equipment early in this process. So again, intermediate agreement, you don't even know what your interconnection allocation is at that point, but you can essentially prepay or post security for long lead time equipment to give the TSP the option to start procuring it. That can help speed up your interconnection. And then there'll be a financial security requirement. Right now, currently $50,000 per megawatt. Note, in the current rule, most of that security is not refundable. I do think that will change if you withdraw your project during a batch study. Right now, the rule says you get 20% back, 80% is kept by the TSPs to offset rate base. After you go through your interconnection study, your batch study, you get your results, and in order to commit and securitize your interconnection facility, which was the result of your batch study, you will have to securitize and execute an interconnection agreement, which will include a non-refundable interconnection fee. Right now, I think that might change, perhaps more refundability if you actually complete construction and take service. You will also have to post financial security for long lead time equipment, which could potentially be drawn down to fund your kayak. Still working on those concepts, and then some type of financial security to help offset system upgrade costs, which is what's socialized through the 4CP mechanism. So thinking about ways to lower and lessen the financial burden of the general public and non-large load customers in the ERCOT system. So again, subject to change, but this is the way the interconnection standards look right now. 4CP. So the update here is the commission did a lot of analysis. They conducted a study on alternatives for 4CP to try to evaluate a more equitable distribution of transmission costs amongst all customer classes. They also solicited feedback on different types of mechanisms to help pay for the transmission system, including minimum demand charge, a separate rate class for large loads, increasing CPs, increasing the measurement interval, um, having removing any allocation or allowance for load interconnections. And what was filed last night by PUCT staff was a recommendation that the commission move from a 4 CP approach to a 12 CP approach with a 30-minute measurement interval, and to implement a minimum demand charge for large load customers that are 250 megawatts and bigger based on either their non-coincident peak demand or their contracted peak demand that they were studied at in the interconnection request. So that will go a long way in helping to offset transmission costs. It will allocate more to large load customers, the 250 megawatt large loads and above. This is breaking news. This will be presented to the commission on Thursday for discussion. The commissioners can certainly change or modify the recommendation, ask for more stakeholder feedback. That's where it is right now, a staff recommendation to make that change. So stay tuned for the open meeting on Thursday. So all this load growth really begs the question of, well, what about supply and demand? Yes, most of what we just talked about is focused on transmission security, making sure the transmission system can accommodate the load growth. But what about having enough supply? The commission is conducting a reliability standard assessment this year. That is the whole point of that process. They will analyze the ERCOT system from a supply and demand perspective for study year 2026 and 2029. It'll include the load growth. Out of that study, which we'll get later this summer, will include how short or long capacity we are, probably going to be short capacity to some extent, and what we should do about it. ERCOT has hired or issued an RFP for a consultant, probably like a Brattle Group, to propose market structure changes to help ensure that we are sending the right investment signals for more generation capacity to help meet the growing demand. What could that be? I'm just making a guess in the bottom in red. What I think will be on the table. Updating the cost of new entry, that certainly has gone up in the last few years. How we designed the dispatchable reliability reserve service product, DRRS, which is going through the early phases of approval. That may need to be strengthened to make sure that we're sending stronger investment signals. Could we possibly increase the system-wide offer cap? Maybe. Think that might be discussed. Peaker net margin thresholds, which is the pricing circuit breaker. Once we have prices that hit a level of 3 times the cone value, that lowers the price cap from 5,000 to 2,000. Value of lost load is what's used in the construction of the demand curves, which were implemented in real-time co-optimization. That's our main scarcity pricing mechanism. You could strengthen those demand curves so that we're sending stronger scarcity prices at higher reserve levels. Those are all on the table, in my opinion, for what will be discussed later this year in terms of how to strengthen the market. And certainly there could be other options as well. Capacity constructs of some magnitude are usually part of the discussion. And then last update I have for you guys, which is also on the topic of supply and demand, how do we get more generation, is the Texas Energy Fund, where things currently stand as of April 20th. We've had a handful of projects that have completed their loan applications and agreements with the PUCT. Those are in green. The yellow projects are still in due diligence with the commission staff, so have not signed agreements yet, but are working on it. There's about 3,500 megawatts of approved loans. 3,700 are in due diligence. So we could end up with around 7,000-ish megawatts of approved TEF loan program projects that are dispatchable gas generation, peakers and CCGTs. And then the red strike throughs, we've had a few withdrawals. Most of those projects that did withdraw have made it clear that they will continue to build the project without the loan conditions. So with that, I will hand it over to Carl.
All right. Thank you, Bill. My name is Carl Cook. I'm a client strategist here at NRG, and my focus is on the ERCOT market. And so we've got a few slides for y'all today to go over what we're seeing right now and help guide you in your decision-making process as you're making sense of everything Bill spoke about, and then we'll check some stuff out here and go from there. All right. First up is some forward pricing charts. This is North Hub forward price analysis, and so that top chart would be the forward curves here. That's calendar 2026 all the way out to calendar strip 32, and the bottom is our percentile analysis chart. Little commentary on what we're seeing right now. Despite the upside risk from large loads in future reliability concerns and tightening reserve margins, ERCOT forward prices have trended down slightly as of late. We've had some mild weather so far to this point in the year, pretty low seasonal demand, and those two things are helping us lower those forward prices in the near term. With everything Bill spoke about, there's still been a lot of delays in the large load energization process, and that's given us a little bit of an opportunity to capture value with these calendar strips trading at the lower end of their historic ranges in the near term. With that being said, in the past few days, we have seen things tick up, and so you'll notice that on the far right of that top chart, as that pricing has started to trend up a little bit, with that long-term forecast being updated, showing that we are definitely going to realize some load growth, as well as some of those regulatory changes. I think some of those things, along with our summer outlook, which is expected to be seasonable for June, but they're talking about August being hot and dry and comparing it to 2018 and 2023. And those were pretty dang hot summers. So something to keep an eye out for moving forward. To help with decision making and to bring some context to the numbers that we're looking at right now, I love the percentile change chart that we have here on the bottom. I'd like to draw your attention to those current percentiles. This is a great way to understand, how has this calendar strip traded historically? And where can I capture value when I'm looking to make my energy purchasing decisions, whether that's for, hedging from managed product or, you're looking for your next fixed price contract. And so looking at those percentiles, you'll see Q3 26, so that's some summer, trading in the 27th percentile. So it's the bottom fourth of that range. So these are great indicators of, is the price I'm looking at going to garner value based on its historic range. Calendar strip 27 is really separated itself from the field. So you'll see it trading in the 24th percentile, going out from 28 to 30. Those are trading in the 60th percentile range. So not as much historical value as, as opposed, so you could always wait and see how those trend. But with a lot of things that Bill spoke about, it's been our belief that there's been a lot of upside risk in the market that hadn't been realized to this point. And with the long-term forecast being adjusted, with a lot of the news coming out about large loads, and then some of these loads finally starting to energize and become real and be a part of our ERCOT grid, a lot of those factors are starting to push up pricing, especially right now. Now, what to watch for in 2026? We've got 4 things here on our chart to keep an eye on and make sure that you're aware of these particular items as you're making your energy purchasing decisions. So the first one is transmission and 4CP exposure are now bigger cost drivers than energy. Of course, we also just got some breaking news on how 4CP might be changing. But concerning the current costs, rising TCOS costs make 4CP mitigation and operational discipline critical in 2026. That postage stamp cost, that cost that you pay for delivery, has gone up to 74 cents, up from 68. And so those costs are going to continue to rise. So if you've got operational flexibility when it comes to mitigating those 4CP charges, understanding your equipment performance, and having some timing and heads up. And of course, we provide heads up at NRG when we think there could be a 4CP alert. Very critical to be flexible and be able to respond to those events to help lower your overall costs. Summer peak pricing remains structurally supported. That's very much true with what we've got going on right now, and with the weather forecast coming up showing that August is definitely going to have some volatility or risk. Large load growth and extreme heat risk keep scarcity premiums embedded in those peak hours. Summer pricing, trended down in previous weeks and was trading lower, but we've seen that shoot right back up with the news that we are expecting a pretty dang hot summer here in ERCOT again. Large load interconnection and uncertainty sustain that volatility. So the VAT study reforms and delayed infrastructure have prolonged those tightened reserve margins, even for existing retail loads. And then lastly here, we've got international conflict and its range of implications for U.S. energy markets. And so, a lot of what's been going on overseas has damaged some facilities that are expected to provide energy to other markets, and we're going to get to that on the next few slides. But that outcome and the future state remain uncertain, and so far conflict has caused supply disruptions and damage to overseas infrastructure. And the reason that's important when we talk about things happening overseas, move to our next slide here, those LNG developments. So in the state of Texas on our coast, we push out quite a bit of liquid natural gas. And they're going to continue to do so. So they've got new facilities coming online in 2026. And in addition to that, you'll look at our chart here, the one in the middle. You'll see currently we're right around that 16 to 18 BCF a day range for LNG send out. So that's how much LNG we're exporting to other areas of the world. It is expected to grow for their maximum output all the way up to 32.6 BCF a day by 2030. So that's quite a rise from what we currently are pushing out to those latter years. And the war is going to have a tremendous impact on this because those overseas facilities have been damaged, and some are going to take as many as 5 years or longer to recoup the amount of export capacity that they have. That will increase domestic demand. So especially when we're thinking about here in Texas and our natural gas market and how that affects power pricing, this would be one of those bullish fundamentals that we look at to point to and say, hey, there's increased demand in the future, and then that world demand that we're going to attempt to meet is going to increase as well because of impacts elsewhere. And we wanted to go over some near-term and medium-term impacts. So those near-term impacts of what's going on in global oil, LNG, and gas due to the war in Iran. For that near term, that's the next 6 months. Oil prices have been supported by geopolitical risk. So any threat that flows through the Strait of Hormuz, it's roughly 20% of global oil and LNG transit, keeps the risk premium in crude. Even limited tanker disruption, insurance spikes, or precautionary rerouting can push those benchmarks higher. And we've seen if you look at the NYMEX and oil prices, you've seen oil shoot up and the NYMEX has ping-ponged around quite a bit. And this week we've moved up, anywhere from 8 to 10 cents in a lot of those months. Global LNG and gas tighten quickly. Middle Eastern uncertainty, particularly around Qatari LNG flows, forced Europe and Asia to compete more aggressively for cargoes. That increase in demand for U.S. LNG exports can provide modest support for Henry Hub prices. And so we've really noticed that, with that Qatari facility going down, it's going to take quite a few years to rebuild that capacity. That has pushed demand to other markets, and it's helped driving up some of those prices, which can impact us here domestically. There's also limited immediate response from U.S. producers. U.S. shale companies typically do not ramp drilling overnight when oil spikes. Capital budgets, rig availability, labor and service capacity create a lag before production might meaningfully increase. So if you're looking for relief in those oil prices, it might take some time before we see producers start to pick up their production and maybe be able to ease prices here domestically. As far as medium-term impacts, kind of the 6 to 24-month range, higher oil prices can drive more U.S. drilling. And so if crude prices remain elevated long enough, producers, especially in the Permian Basin here in Texas, may gradually add rigs to capture those strong margins. Now a kind of a byproduct, a benefit here for associated gas production. So associated gas production increases alongside oil. So when they're drilling from oil, there's associated gas that comes from that production. And more oil-directed drilling means more associated natural gas coming out of those wells, even if that's not the primary target of the oil drilling. Lastly here, a potential cap on domestic gas prices later. LNG exports can tighten the market in the short run, but rising associated gas supply from oil drilling could eventually add enough supply to moderate those U.S. gas prices relative to the global markets. And if you've been paying attention to the global markets at all, you've seen a pretty dramatic rise in those prices. Now, I wanted to go over something that we've had a lot of questions about lately, and that's real-time co-optimization plus batteries. It's called RTC plus B, and this is a program that went live in December of last year. It's a new ancillary service. So I want to break down what it is, what the perceived benefits were, and then the next slide will go through the performance that we've noticed so far. And so to explain RTC plus B, RTC is the process of dispatching energy and ancillary services interchangeably in the real-time market. And battery resources are modeled as a single device with a state of charge constraint, rather than before where they were viewed as separate load and generation assets. So it's a big change from the way it was before. They're viewed separately. Now it's just as one with a state of charge constraint. And so this is going to enable much more accurate dispatch and better utilization of battery storage in real time. That way, when we get into those solar ramp down hours and we're looking to discharge batteries to help with meeting demand during those times, they're going to be much better set up to do so. And the security constrained economic dispatch is called SCED, if you see that out on anything you're reading, automatically selects the least cost mix of resources to serve load and meet ancillary service requirements, reducing operator manual actions and reliance of out-of-market solutions. And so some of the benefits that ERCOT marketed beforehand, the one we'll go to that bottom bullet real quick, because the what stood off the page for me when I was reading their white paper was the estimated savings. And so ERCOT estimated approximately $2.5 to $6.4 billion annually of reflected savings because of efficiency gains from real-time co-optimization. So that's a big number and a big spread, and we'll see how it's panned out so far on the next slide. But the benefits that they spoke about beforehand were operational improvements, including better congestion management, timely ancillary service procurement, improved ancillary service management, and using a broader set of resources and real-time capability information. So how's it done so far? We went ahead and, it's been a few months now, and we've had enough time to gather data and understand performance of this particular ancillary service. Of course, it went live in December of 25, and performance through March has been stable. And that includes a winter stress event. So that includes Winter Storm Fern, which definitely put stress on our grid. We had some pretty high peak demand, up to about 85 gigawatts. And during that time period, RTC plus B performed pretty well, with scarcity largely absorbed in the ancillary service markets rather than causing broad energy price blowouts. And that was definitely our observation during that time. A lot of the volatility that we observed in the real-time market were pretty acute spikes for smaller intervals. A lot of that came in the mornings, and definitely avoided some overall volatility due to the new program. Real-time congestion and basis have become more localized. So with batteries and ancillary service playing a larger role in managing constraints, it's increased node-specific and short-duration basis exposure. And RTC plus B is not inherently price inflationary. It reallocates risk from the averages to tails, making real-time events and ancillary service tight hours more consequential for load. And so how does this affect you, the customers? Fixed energy manages those averages, but procurement strategies should be reassessed with index exposure, CRR coverage, and nodal risk heading into higher load periods. And so, from what we've observed with RTC plus B so far, and a lot of those risks becoming more localized, if you are in a particular area that you notice the congestion risk, that's something that you might need to start to address moving forward, as opposed to maybe not thinking about it as much in the past, but this is something that you might want to dig into, especially in the Western region. All right, and that is all I have from the strategy perspective. I wanted to kick it back to you, Cindy. Do we have time for questions?
Thanks, Carl. And thanks, Bill and Carl. Great content, of course, as always. Yeah, we do. And so let's move into Q&A. It actually looks like our first question is for you, Carl. You mentioned this a little bit earlier, too, but help us explain how the war in Iran affects current power contract prices in Texas.
Absolutely, yes. We covered it a little bit on that slide, but just to reiterate, if oil prices stay high for long enough and encourage additional drilling, the associated gas, that natural gas that comes from the drilling process, would increase natural gas supply domestically and could potentially bring down prices. And so a lot of that goes on in the state of Texas and provide, additional gas to increase our supply and could bring that price down. We do have increased LNG demand and send out from the Texas coast. With that and, everything that I showed in that chart, those facilities are already running at max capacity and will continue to do so out to 2030. So kind of regardless of what's going on with them and, the additional drilling, we could see some easing in prices if oil stays high long enough to get the associated gas from it.
Nice. Thanks, Carl. All right, Bill, you're up next. Our next question. Please discuss the shrinking reserve margin in ERCOT and the potential impact on the market and wholesale prices for 2027 through 2029.
All right. Yes. The latest CDR report, Capacity Demand and Reserves report that ERCOT publishes, which shows projected reserve margins, does show every single year in 27, 28, 29 going negative. That's obviously not good. It's a 100% chance of firm load shed. But that, of course, is using those load forecast numbers that we looked at. So really, I think the focus is how are we ensuring that we are increasing supply along with load growth. There is going to be load growth. It's not like we should just ignore those numbers. We're going to have significant load growth, more load growth than we've ever had in the history of the ERCOT market, more than likely. But it also is going to run into physical constraints and limits on what the transmission system can serve and also what supply and demand will bear. So really, when it comes to reserve margins, the focus is on what's bringing new generation. So TEF, we talked about that already. We're going to get probably 7,000 to 8,000 megawatts of new gas projects built through the Texas Energy Fund. Those projects are specific to the ERCOT system. You can't build a TEF project and park it behind a data center. So that will be new capacity. And then we also see the reforms through DRS, Dispatchable Reliability Reserve Service, I think will help provide some additional financial incentives. And then obviously all the Senate Bill 6 stuff. So my personal view is, and there's a lot in the queue, generation queue. You see a lot of wind and solar, a lot of solar and batteries that are still in the queue. So I think that will continue. But the main thing that I think we're going to see and going to need in the next 3 to 5 years is a significant increase in demand response. We will be able to build generation to an extent, but not enough to serve all the new load, in my opinion. And that means we need strong incentives to grow demand response and to encourage traditional customers, businesses to install capabilities to be able to participate in demand response. And also, we need a lot more reach into the residential market. We need to grow residential demand response offerings through thermostat aggregations and home battery system aggregations in a much, much bigger way than we have currently. So again, those incentives will present themselves when we have load growth. You'll see prices rise. That will cause a reaction in the market to increase demand response capability and new supply.
Great. Thanks, Bill. And actually, to stay on the large load growth conversation here, based on your viewpoint, the next question is yours. Based on your viewpoint, are ERCOT's large load queue and large load forecast realistic?
No, I don't think they are, and not through any fault of anyone trying to implement the correct policies. But obviously, the interconnection queue, just like we see in the generation side, is always going to overstate what actually happens because they're just requests. They're inquiries. I'm interested in thinking and getting information on a site that I may develop at. So I'll file interconnection request. I'll get study results. I'll look at and see, does that site and these study results tell me that it's a good location that I can develop on? A lot of times that answer is going to be no. So the queue for sure is not realistic. The load forecast right now, unfortunately, in my opinion, is way too high. And we need to do some more work from a policy perspective on making sure that the large loads that enter into the forecast meet a higher standard and more criteria for what's real. I think that's going to happen naturally as we move into 2027, and the more strict criteria that was approved through the PUCT's rule it becomes effective, which means you have to have a signed interconnection agreement, meaning you've had to have completed your studies, accepted your allocation, accepted the results of your study, posted financial security, paid for your interconnection costs, then it provided updates on your development progress, then that load will go into the forecast. So I think we'll see a better, kind of more accurate load forecast next year. Thanks for the questions.
Awesome. Thanks, Bill. All right. So looks like our next question is for you, Carl. For those of us thinking about the rest of the year, what's to come, what is the market outlook for summer and fall?
Absolutely. So we did just get our summer weather outlook a couple of weeks ago, and it shows that we've got an El Nino expected to be the main driver of our summer forecast, that it heads to a moderate or strong levels during the summer. It favors a warm west and south, but a more seasonable Midwest and east. And so those key comparison years are like 23, 2015, and 22, with a warmer 2018 analog included due to drought similarities. That was from a late blooming El Nino. And so for ERCOT specifically, our forecast projects a warm and seasonable June, and then we'll move towards a pretty hot and dry August. And so when they're comparing that year to 2018 and 2023, that's when we do get concerned. If you look back on some of the charts that we've shared, August 2023 is what's keeping that 3-year average for real-time prices high on any chart you look at for real-time, because August was very hot, a lot of days over 100 degrees, and that definitely produces a lot of volatility risk. And so those warm risks, that slower moving El Nino would favor a more hot and volatile risk early in the summer. So depending on when that shows up will be the timing, but we are expecting some above average heat for August. Definitely something to watch out for. And then as far as the fall goes, we will have more information kind of late in the summer on exactly what our weather forecasts are for fall.
Great. Thanks, Carl. Actually, last final question for you, Carl. Why are Texas electric futures still inexpensive given the current geopolitical environment?
Great question. Thank y'all. So for as far as why the futures are still inexpensive compared to the overall market, and especially when you're considering that current environment we have geopolitically, the first is there's a lot of wait and see. The reality is getting in the way of large load growth. There's a lot of things that have to happen for those facilities to actually come online. And so there's a big backlog in the queue. There are infrastructure delays. So if you're trying to get gas turbines, steel, microchips, really whatever part of that, there's a massive backlog in procuring those particular items. In addition, there's labor shortages, and there's been a lot of regulatory change. And so there's a lot of things that are happening in real time that need to happen that are getting in the way of us realizing a lot of that load growth in a more expedited fashion. So that's helping us out in the near term. ERCOT's also insulated from a lot of geopolitical risks due to dynamics from our local gas supply. We're very blessed in the state of Texas to have tremendous natural gas supply, the ability to supply our own market. We have an energy-only market, and we're separated from a lot of those other markets that have a lot of more volatility from what's gone on overseas. If you looked at, pricing in the Northeast and how things have behaved, their impact from what's going on in Iran is much more significant. And so we really have been lucky due to our market dynamics to avoid a lot of that because we have such tremendous local supply and capabilities. Still with everything we're seeing, and we're seeing pricing starting to increase right now going into summer. Of course, that's, pretty seasonable thing that happens on average. There does appear to be a lot of upside risk. And so you'll hear this from, potentially us. If you look elsewhere in the market, you'll hear folks talking about that upside risk that's really not being realized because a lot of folks are just, waiting to see what happens. And then when we have an event, that'll push pricing higher. And so in the near term, we do believe that there's a lot of upside risk. We talked about a lot of bullish fundamentals today that would push that market up higher in the future. Of course, the timing with new generation coming online and those loads coming online will have a lot to do with how power futures react. But for the time being, a lot of what we're seeing is a lot of bullish risk in the future.
Great insights. That was our final question. Thank you to our speakers, Bill and Carl. Thank you for your time, your insights on what's really going on in ERCOT today, helping guide us here. For those of you, if you're interested in future market updates, we have both Canada on Thursday, the 7th at 12 p.m. Central, and California on the May 12th. As always, we're ready to help. Please reach out to your account executive with any questions on either today's content or if you want more information on other markets. So just to close us out, following today's webinar, you'll receive an email that will give you a link to our website. It includes helpful information just to keep you and your prospective customers in the region informed. It also includes the recording of this webinar. We also ask that you take the survey. It's brief. We really appreciate your feedback. Thanks, everyone, and have a great rest of your day.